Welcome to season 2 of the podcast. We're excited about this new season. We'll continue to build on the same kind of format that we had last season. We have lots of new entrepreneurial stories. And then you might have noticed that we renamed the podcast Startup Stories from the Treehouse. So let's kick it off. So the first episode that we're going to do is a webinar I just recently did called Surviving the Financial Winter. We know that fundraising for startups has gotten way more difficult over the last 18 months. And there's kind of a discussion around two entrepreneurs and two folks from the finance side. And they really kind of talk about the root causes, what you can do to really kind of survive and succeed in this environment. And there was a lot of interesting kind of takeaways on this. So why don't you sit back and enjoy this first episode, Surviving the Financial Winter. Okay. Well, with that, I'm going to basically turn it over to each individual. Like I said, we have two entrepreneurs and then two folks that are from a professionally managed investment standpoint. And so I'm going to kick it off with Bridget. Bridget, do you want to go ahead and introduce yourself?
Yes, absolutely. Hi, everyone. My name's Bridget Blody. I am a co-founder of a tech startup called Fomeno. Essentially, what we do is we're an aggregator in the secondhand clothing space. A lot of people compare us to Kayak or bookings.com, but for online thrifting. So we tap into all these online thrift shops, filter out the products that we anticipate will sell fastest or be just like the most desirable to our customer. And then in doing so, we've created this essentially online marketplace of the best secondhand clothing. So yeah, I've been at it for about 4 years now. And when I say been at it, like that's when we first, had the idea of the company, started testing things out. We've raised some capital, just a little under $500,000. And throughout the last 9-ish months, we've been actively fundraising in our seed. So super excited to chat with you guys about some of my experience.
Okay, well, thank you. David Kingman, you want to go next with Property Meld?
Awesome. Well, great to meet y'all. My name is David Kingman. I'm the co-founder of Property Meld. So Property Meld is a SaaS startup based in Rapid City there. And so kind of our customer is professional property managers. So if any of you've ever rented an apartment or a house and had to deal with maintenance, you've probably realized how terrible that experience is. And so that was kind of the genesis of our company of tackling the problem from all angles. There's a lot of different parties involved in maintenance. And so we set out to make that process, two things, more efficient and a better experience for everybody. So we've been doing that for past 8 or 9 years or so. And learned a lot.
And maybe just an add-in too for that is you've raised probably somewhere in the neighborhood of $25 million through multiple rounds. And so I think the maturity and the steps and the changes that have had will be interesting to hear from your perspective. Okay, great. Thank you. Jim, you want to go next?
Sure. Queen on here too, if I can.
Yep, there you go.
All right. Yeah, my name is Jim Quinn. I am currently the chairman of the Black Hills Regional Angel Fund 3. It's the third, obviously, of other angel funds that the first two we've developed, and they are fully invested. We are probably halfway through our third fund. Also a member of the Homegrown Fund, which is kind of a second round Series A type round group, and also an advisor for them.
Okay, very good. Thank you. And Blaine.
Thank you. It's a pleasure to meet with you all virtually. I'm Blaine Chrisman, the founding partner of Badlands Capital. We're a growth equity and private equity focused fund in South Dakota. We invest in the Upper Midwest, primarily Series A through control buyout. I started my private equity investing career in the late 90s. So I've been investing through multiple cycles. I think it's insightful for Todd and Mike to get this forum together because capital markets change and it affects early stage companies. So I've seen a few of those cycles and I'm looking forward to talking with you all.
Good. Well, thanks. I guess maybe that's the good lead into this, Blaine. I think, getting an understanding of kind of the macroeconomics and how things have changed and why things have changed, I think is important. If you think back a couple of years ago, capital markets have gone through a fair amount of change, and probably most likely because of just the interest rates, right? As the interest rates got to zero, it's creating some different behavior. As interest rates climb, it's creating some different behavior in the market. So with that as kind of a backdrop, do you have kind of an overview that you could provide that maybe is kind of looking at the macroeconomics that kind of lays the foundation for the rest of this discussion?
Yeah, there are a couple of interesting things going on in the last couple of years. Interest rates a primary driver, as you've identified, Todd. It's a continuum of capital from seed, early stage, all the way through IPO. And when one part of the continuum gets backed up, it affects others. So to identify what is affecting seed, Series A, Series B, you need to look at interest rate environments. Todd has identified they've raised 5.5% over the last 18 months. If you're an early stage company, you're not borrowing money. Well, how does interest rate change affect your business? You're affected by pension funds on the coast, large institutional investors. When interest rates are low, they're stretching for yield. They'll take more risk. They're allocating more to venture capital funds that are then looking to invest in your companies. As interest rates rise, risk profile changes. Large institutional investors can reach their targeted returns by taking less risk, and money dries up to venture capital funds, affecting your funding. So interest rates rising, reducing risk profiles and allocation of capital. A couple of other things I'd identify too. One is inflation, not only inflation in physical goods, but payroll inflation. Engineers for early stage companies were getting $100,000 to over $1 million if you're a coastal experienced software engineer. And so as burn rates and allocation of capital to leased space and talent primarily went up, it changed the risk profile overall. And so venture capital was less likely to allocate. One other thing I would add is we are now almost 4 years post start of the pandemic. There was a lot of capital flooding into the system. Everyone thought behavior would permanently change because of the pandemic. Behavior has changed a bit, but not permanently. And a lot of that billions of dollars of capital flowing in has dried up. So it's stressed business models, especially on the early stage. So really, to summarize, interest rates, inflation, and now 4 years post start of the pandemic, the world has settled into more of a 1990s world than 2020 to 2022. And business models will have to adjust. Winners will be those that have capital, cash on the balance sheet, and are efficient with it. Those who are addressing particular segments of the market that are less interest rate, inflation, and macro driven, less real estate, more solution service business. And so whether you're an early stage company in Canada or the Midwest, you're still affected by macro trends from the coasts and even globally.
So that's helpful, Blaine. I guess maybe digging into this a little bit further, do you think that the impact from an investment standpoint has been distributed kind of evenly between angel, Series A, Series B, Series C? Like, I guess what I would say that I've seen is maybe there's less impact on the earlier stages. And then basically as this, as interest rates and stuff has climbed, money has gotten harder to get for Bs and Cs. We don't see hardly any, IPOs over the last couple of years. We've seen a lot of companies that have been, more mature companies close shop in 2023, probably more than we've seen since 2001. And so I just don't know if that distribution of getting squeezed is evenly distributed all the way through that maturity curve.
It isn't, but I would look at it in a time sequence as well. At any point in time, it's unevenly distributed. And again, it's a continuum. Risk profiles change, IPOs dry up. I would also say private M&A activity dried up and is currently challenged as well. And so that BCD leading into an exit event, either IPO or sale, dried up in late 2022 and all of 23. You're seeing it now affected by A, which was looking to raise in a B or C, and the wave is backing up. It's going to be affecting early stage fundraising as well. Now, ways to win in that environment are how sensitive, how flexible are you in valuation, in structure of the investment. High valuation, high burn early stage companies are being challenged. One most recent data point, Todd, a company that we've invested in that is looking to position for a B, is hearing from Midwest B2B SaaS investors, we want low burn, lower valuation companies that have raised less before we invest, because we don't see the 5 to 10x in a C or D round. And so we want to get in at a lower valuation, still put our 10 to 15 million at work. And so if you've raised a lot of money at increasing valuations, you're less attractive to at least that Midwest 2 to 3 times our money, lower risk profile. If you can tell a total addressable market and a $200 million enterprise value to a coastal investor, you're still in play. But
Okay.
valuation and amount of capital raised so far will affect that early stage as well.
Okay, well, that's good. Thank you for the context. I appreciate it. Bridget, maybe you can talk, maybe to like transition to this is what's it like out there, right? I mean, you've said you've raised a little under 500,000 and now you're actively going out. You and I had a conversation probably 3 months ago, something like that, where you're kind of out there doing it. I thought you had some really interesting insights to kind of bring to that. And so maybe just talk to me a little bit about your kind of fundraising experience and what are you seeing on the ground?
Yeah, absolutely. So we've been fundraising for, I guess we officially, started raising this summer around June, July. In hindsight, I would have liked to maybe started 6 to 8 months prior to that. I think one of the best tips of advice, even just from doing this, as we're, raising a seed fund, is that I think the earlier you can start, the better. And what I mean by that is just like, ultimately, investors are investing in people who are building these companies. And if you can get to know them earlier on, rather than when the capital is really, starting to be needed more and more, the less pressure you're putting on yourself, especially when the environment looks like it does right now. A lot of times, like raising money is completely out of your control. I'm seeing a lot of colleagues and friends who are raising seed rounds right now. They have amazing products. And they're really struggling and they're getting really low on runway. And it's not necessarily their own fault. They maybe just didn't start early enough. And that, in combination with the environment right now, it puts them in a really tricky position. So I would say the earlier you can start, the better. Just even having, like I said, those easy conversations with investors who potentially would be interested in your company. Yeah, another thing I think that's really interesting, and I mean, Blaine really touched on this previously, is that, I was, kind of naive in the fact that the industry that we're in, secondhand, is growing faster than retail. So resale is growing faster than retail. It's a $177 billion industry, expected to double in 5 years. It's growing rapidly. And I just kind of assumed, investment funds would correlate with that growth. And that's just not necessarily true. Because like Blaine was saying, just the state of the environment and what's going on, you're really starting to see that also, a lot of companies are asking for bridges and they're asking for these additional investments, and that back piles up to when you're like raising pre-seed and seed, because, the fund ahead of you or the stage ahead of you is tapping back into the resources that you're also double tapping into. And there's just ultimately less funds to go around. So, another thing we've really been seeing is that, there's less checks that are going out, but the check size is bigger. So a lot of people who have been raising in seed, the ones that are doing it right are getting a check in and they're raising a lot of FOMO. And in doing so, they're oversubscribing their rounds. So they're setting, their target a little bit lower because they want to hit that benchmark. And then, all these other investors, because it's such a risky environment, they're like, oh, XYZ went in. We really trust their, perspective on investing. We know that they know what they're doing. And then this other person wants in and this other person wants in. And all of a sudden, your $3 million raise is an $8 million raise. I've seen that a couple of times, which is crazy. But it is happening. So yeah, I would say the earlier you can start, the better. It's totally possible. It's just, it'll probably take some more time and more creativity on your part. A lot of no's are not indicative to your company or who you are. It's just the state of the environment right now. And it is just simply harder to raise. And then also another piece of advice that, I was given early on, which I think is really important right now, is a lot of times I think seed stage companies feel like they need, a venture capitalist to lead their round, and they only want, a few parties in, which is great, very ideal. But in environments like this, you just need to get the capital so you can keep your business running. And if that means you're taking a lot of smaller checks, it means you're taking a lot of smaller checks, generally from angels. So I think that, when VCs, seed stage VCs, should be the riskiest probably investors out there. And in times like this, very similarly to what Blaine was saying, they're just not as risky. Sometimes you do have to really tap into those angel investors to finish those seed rounds. So that's kind of just a spiel, but that's ultimately what I've really been seeing in this environment right now.
Well, good. Well, I appreciate it. That's good context. Which, I think some of the smaller checks and stuff, and maybe some of the seed investment you're seeing, maybe this transitions well to kind of Jim and talking about the angel network. I'm curious, Jim, from your perspective, maybe give us some background on kind of what an angel network really does, maybe how some of the stuff is structured. Are you seeing some differences in kind of the deal flow and valuations over the last couple of years, or even from Fund 2 to Fund 3?
Yeah, good lead in on the previous talks also. I guess let me start, with some advice is, don't take any outside or diluted funding unless or until you really need it. Because, that is, if you can bootstrap, go as far as you can and as long as you can, because, you're going to have to give up some ownership if you start bringing in outside funding. There are some early fundings available out there you should look into, and those are things like the state or the SBIR type programs. Boot camps can provide some money. Also various competitions. You can actually win some money if you compete in some of these pitch business plan competitions and such. So, and they can be used for things like your proof of concept, early stage research, prototypes, etc. And, they're basically encouraged by angel funds too, because they help de-risk the funds first, funds investments also. So take advantage of them if you can. I'll talk a little bit later here just about, what are the identified stages, and I'll talk about what are the stages that you're going to actually look for, in startup development, and what are the things that you probably need, or what kind of funding you should seek, for those different stages that you're at. So Todd asked, kind of, well, what is an angel fund? Basically, it's just a simple pool of money that's been created by a group of individuals and for investing in startups. They're usually some of the first funding that comes in before your 3 Fs, which are the friends, family, and fools. Hopefully, there aren't too many of the fools on your group, but anyway, there are basic rules for agreements signed to determine voting rights for the fund. Specific startup focus, investment commitments, and other legal details. Deal structure. As far as structure, we usually use a convertible note type document, which is basically starts out with a loan paying interest, and then with the intent to convert that fund or that loan to shares of stock, based on an agreed valuation and at some future maturity date. As we've learned kind of in our first, 2 funds, we've kind of moved towards more of a safe type agreement, which is very similar to a convertible note. It's a simple agreement for future equity, and what SAFE stands for. And there, it's, the valuations are not set at the beginning of the document. In the convertible notes, we usually try to get the valuation set as part of that, but the valuation is based off of a value determined at some kind of a buyout or liquidation event. So you actually have a market price, and then the buying party sets the market price, and then the stock, and is usually some type of, or the early investors get some kind of a discount on that price when, because they bought in at a much earlier, higher risk level. Todd also mentioned, kind of talk a little bit about a board seat. When you ask for outside funding, investors are going to want some type of oversight on how you're using those funds. If an angel fund is leading that, is a lead investor for a round, they're going to set, and they're setting the terms. They'll ask for some type of position. They'll ask basically that you form a board, and they'll ask for some type of observer or voting seat on that board, just to be able to monitor what's going on and make sure you're spending the money as you told them you plan to do it. Blaine and Bridget have talked about kind of the current investment market, and I'll just throw in my 2 cents here too. Valuations have probably been our biggest change and the key focus, for our funds at these early stages. It's always difficult for an angel fund around to determine, reasonable valuation for a startup because it's so early in the process. Most of the time, the company is in pre-revenue, and there are no good measures, for their potential success and the ability to actually get to a real business. It's kind of there at that early stage, so they don't have a lot of this, a revenue stream or something they can really depend on or look at as far as determining valuation. So it's really just an assessment, which I'll talk on a little bit later here of what the things are that we look for. Entrepreneurs, you've all heard and seen, actually Blaine really talked about it, is, media about companies being funded for astronomical valuations, and they expect that they should be able to, startups, expect that they should be able to do the same thing, get those kind of big dollar amounts. And again, recently valuations are coming down considerably, and we've been pushing back harder on setting those valuations at more realistic levels, for these early rounds. Because if you push the valuation too high, as Blaine and Bridget mentioned, in those early rounds, it makes it much more difficult for getting larger investments at those later rounds. So, you need to try and keep them down so you can actually be ready to handle the higher rounds when you're really ready to go forward. Because, like I say, in those early stages when you're pre-revenue, it's a shot in the dark as whether or not you're actually going to be able to make it. Todd asked about, well, what's an ideal startup? And I got a couple things here to look for. It's and key to us is, and the first thing to look at is, high quality and coachable team and entrepreneur for the business. Do they kind of understand that it's more than just having a good idea, that you need to have, a team that knows all the business sides of the work to put a startup in place and knows how to get there. They also need to have a clear understanding of the value proposition for the target customer. That's a key that we look for, that how well and how good is their value proposition to really be able to become successful. Next thing is really a solid business model, and if you hopefully know what a business model is, it's a key tool for kind of going through and trying to assess what you know and what you don't know about your company and what you're trying to do. And then along with that, a written business plan, that kind of takes all that stuff you'll learn doing the business model and exploring the customers' needs, that identifies, what I was going to say later here about, the stages, what are the stages of development? Really have some kind of a structured process that you thought through that, identifies what are the various stages of development and what do you need to do to be a successful startup. And then, like I say, define those stages and with measurable milestones for each stage. So an example, what kind of stages and funding sources, go along with each of those stages. Is it, the first one really, and this is just an example, there may be different ways that this would be structured, but really for you to define those key steps and stages. But the first one really is kind of, you got an idea, you've done a business model, run through of what are the key points to it, and you do have a plan for how you want to go forward. And this can all be, this doesn't require a lot of investment, so that's probably something you should focus on bootstrapping, and that early work of just kind of setting up, well, gee, is my idea really a business or just a great idea? Then you kind of go into, the customer, proving out who your customer is, and market exploration of, is it something that the customer is willing to pay for, and how much value are you bringing to them? And that's probably where you probably get your first funding from the three F's, the friends, families, and pool, to get you there. Probably the good next step is kind of that proof of concept. And this is where I talked about, well, there's some state and federal funding you can potentially get. Again, maybe a friends, family, and pool. Boot camps can potentially provide some of this. And then the angel fund would be a potential investor at that level when you actually have a proof of concept for what you're trying to do. The next step to me, their stage would be like a minimum viable product, prototype, and potentially ready to launch, launch your business. There again, that's probably the key heart of what angel funds would be looking for. Your pre-revenue, you may have some revenue, you may have some customers lined up, but it's kind of still there. Next step is when you actually do get to revenue and you're getting ready to try and scale up. That's where you kind of look at your Series A round. That's your first kind of bigger level chunk of funds. And then kind of, well, when you're ready to go out and conquer the world, then you start looking at those Series B, C, and Ds that really need big money to build your plants, whatever it is you need for those bigger stages. And then there again, defining what you need to get to the next stages. And again, one of the things we've seen in our experience is, you don't want to ask or expect that you're going to get all the money up front. It just becomes too big a number, and there's too much risk, too many unanswered questions there. So, do it in small chunks, set your valuation realistically, and work forward. So, the process you go through is do the work to de-risk, at each stage. Once you define your stage, define the work that you need to do it. It should increase your valuation because you hopefully have de-risked at some point. Determine the funds you need for the next stage. Go out and seek that funding, and then repeat. So those are my recommendations and input.
Well, thanks, Jim. I think there was a lot in there to unpack. Just as a reminder, I know some people joined late. If you have any questions kind of through this, just put them in the chat and we'll get to them towards the end. So that's good. Kind of maybe move into David and Property Meld. You guys have gone through kind of this whole kind of litany of funding, right? You went from friends and family, you did some angel network, you worked with Blaine, and then now you've got some more institutional investors, larger organizations on the coast. So you've kind of seen kind of each one of these. I'm curious on how like each one of those processes maybe has changed. Maybe even just like, I know, for a long time, I think when maybe access was more available and easier to get, we talked a lot about just growth, right? We talked about growth, not at any cost, but I think that was really kind of one of the big markers that we had. And so I'm kind of curious about the evolution of Property Meld raising money through all of those, and then maybe how maybe some of that's been changed by the current market opportunities, as well as some of the investors you've had.
Yeah, we've gone through, like I said, every type of investor for the most part at this point, and they're all different. One thing that's been common is like every time we've raised, there's been, a new set of expectations put upon us in the business. And I think, as a result of that, it's always made us better. I think it's always been an evolution in its, growing pains, going from friends and family, very different from going to an individual angel investor and then even a group, an angel fund. And so, kind of culminating into our Series B, where we raised $15 million from a Frontier, which is they have over $1 billion under management, very professional. They have dozens of portfolio companies and have dozens of successful exits in their track record. And so, that was probably the biggest jump for us from a learning curve, going from, I think Blaine and his group is an investor in Property Meld, and that was also a big jump. But going from that to Frontier, I don't think we were quite prepared for. And so, we've had to go through a lot of growing pains to get there. And, on top of that, we've had, the macro environment has changed kind of from underneath us. And so we had to figure out kind of all this stuff out at once. And, in particular, focusing on getting to profitability. I think previously, not just us, but I think the market in general, everybody was focused on growth at all costs, as you guys said. And, burn was kind of obviously always there because you always have to have a runway. I don't think anybody ever completely got away from looking at runways, but just the level of scrutiny on where our dollar is going has changed dramatically. And so I think ultimately for us, it's been very positive that, we went through some challenges early in 2021. I think we learned some of the lessons that I think a lot of people are having to learn the hard way now around, growth at all costs, essentially. And so ultimately, we had to determine what are the core set of metrics that we really need to focus on. And for us, it came down to churn. And so, the difference between for us 70% growth with 80% churn, or 45% growth with 90% churn. Previously we probably would have been like, 80, 85 or 90% churn isn't that much of a difference, or even 80% to 90% churn is not much difference. We need to
Let
get
me
to
just super
70%
clear,
growth.
like that's retention, right? Like you're not churning 80%, you're basically retaining 90% or 85%. Just being super clear.
Yeah. No, good. Yeah. Gross revenue retention of 80%
There you go.
or
All right.
90%. There you go.
Appreciate that. You got no business at 90% churn.
No, you're probably not going to have a business very long.
No.
And so, that's been our core focus, is improving retention and driving down churn. And I think that's, again, the industry as a whole is kind of forcing that message on everybody that every dollar in is an investment, right? And I think that's, even from Blaine joining the investment into Property Meld, the focus on, just finance in general. I think we've, again, leveled up through our trajectory as a business. I think kind of culminating with Frontier, getting to a level of sophistication in our reporting and understanding of a lot of the big metrics, right? Besides just growth and retention, there's customer acquisition cost, and there's a whole litany of metrics that we have a handle on, but probably a bit too muddy for professional investors take.
So yeah, maybe to build on that, I mean, I think you've hit it. I think the financial maturity that you guys have gone through over probably the last 2 or 3 years has been, pretty impressive. And I think every step of the way, as you take more capital, or it's more different capital from different organizations, the expectations, they want to make sure that your balance sheet and everything is something that they can compare apples to like companies. So they want to look at metrics that are happening in your business and be able to compare those SaaS metrics to somebody else to kind of baseline where you are from a market valuation. And so I do think that's been a big kind of step function for you guys over the last couple of years. Maybe to close out this section, maybe talk to me a little bit about like the role of the board over time. I mean, I feel like I've been on your board for a bit. And so, I think a lot of it was an advisory committee to kind of a readout, to now it's much more of a strategic asset that basically we all have to kind of get on the same page about kind of how we're spending money and where we're going.
Yeah, I think, one of the big things is predictability, right? I think, ultimately, to me, what like we've learned through this past year and a half is we have to be much more predictable. And I think it's partially the job of the board to make sure that's happening. At a certain point, I think that becomes table stakes. But for us, we just had wild variations. We'd have a great quarter, and then we'd have a bad quarter. And our ability to predict what's happening was like really poor, both from like the financial aspect and the underlying metrics components of that. And so having a professional board for us meant that we had to be much more predictable. And again, going back to like the efficiency standpoint, most startups that are raising money are burning capital, right? They're not to profitability yet. And so if you don't have good answers for why you spent this much or why you didn't get this performance, the board's there to hold you accountable and to ultimately help you in the big decisions. There's like some simple things that we went through that are kind of specific to our business that we were so tunnel visioned on what we've been doing that the board was able to kind of pull us out of this decision that we had made, because we had, you're working day to day and you don't see these things that have inertia but are not going in the direction you want them to go. And so I think to me, a good board will help elevate you and pull you out of those things. And sometimes it's not pleasant, but that's like been very helpful for us.
Well, good. I think that's a good recap, David. Thank you. Maybe Blaine, kind of turn it to you. I'm curious on how deals over the last couple of years have changed for you guys, right? And so, we've talked a little bit about seed rounds and how they've been affected. You're much more from a maturity standpoint where they've got some product market fit. You've got a bunch of customers, you got a trajectory, you've got some of these benchmarks of what lifetime value looks like, you got customer acquisition cost. We've got kind of a first baseline, certainly a financial by the time you get involved, because that's what you're looking for. But maybe you can talk a little bit about how that's changed over the last couple of years for your organization.
Yeah, I would say with Property Meld, David and Todd actively involved. David as a co-founder is a perfect example, and they've spoiled us a bit in that David has always been capital efficient. And that's one of the hallmarks of Midwest early stage companies. There aren't beer taps, bean bags, dogs in the office type of thing. They're focused on building a product, getting to revenue, scaling. And so to me, that's a constant. And if you're an early stage founder, I look at it controllables, what can you influence and what's uncontrollable. You can control spend for the most part. You can influence sales and the product you're developing. You can't control capital markets and macro environment. And so control spend, influence sales, and position yourself to have flexibility to withstand uncontrollable macro shocks. And so to me, as we're looking at that and the evolution in the markets we've talked about over the last 40 minutes, the founders who are better at the controllables and influence, we're more interested in. You can't be speeding to the edge of the cliff and hoping you can raise capital to extend. You have to be controlling every day. And Todd and Mike didn't ask me to do this as a commercial. We didn't coordinate that. But if you want to be efficient, work with people who have done it before. And even pre-revenue, building out the product and testing with customers and getting to revenue so that you can scale. David's identified it. Every dollar spent is an investment that has to be done wisely, and especially at the early stage.
Yeah, I think that is good advice. I think I guess I'm kind of interested on just even valuations, right? That's certainly something that entrepreneurs all focus on. And a year ago, a company that was growing 40-50% or more could be looking at anywhere between 12 and 14% ARR. That same company today could be looking at, for that same sort of growth rate, looking at 6 to 7x maybe if they're lucky. And so is that something you've seen? Are you seeing are those hard conversations? Being capital efficient is not the same as growth. And so it's just I think a lot of the dynamics in the industry and kind of what you guys are looking for has changed a little bit over time.
It has. And Todd, you and I have talked about it offline. It depends upon what your ultimate goal is. Do you want to build a 100 million in enterprise value customer, expose yourself to capital markets risk every 18 to 24 months, needing to raise at a higher valuation to be able to reach that point? Or do you have a really good product and a solution? Maybe it's a niche, and you raise once, 1.5 times, and get to 30 to 50 million in enterprise value. That's a great outcome and a business that's sustainable. And so early on, you need to be talking to your board, your advisors, because Todd, you're exactly right. We have seen seed stage valuations drop below $10 million. And one of the other points of sensitivity as you're looking to raise the next round, we've seen it in other companies, is how much do founders own? If you've diluted yourself down raising in a serial approach, when you eventually get to an A or B, they're less interested because the founders don't own enough of the company. So this is a plan early on and sticking to it and having experienced advisors like wildfire and an experienced board, or you'll get stuck in a corner, be orphaned, and fail to launch.
Well, that's good. I appreciate it. I think you're dead on. And it's interesting. You're seeing some companies, maybe to your exact point of maybe now they're holding on to equity and they're raising less capital. They're maybe growing slower. And instead of maybe looking for that $100 million exit, they're basically taking the $35-40 million exit. But yet their ownership in the company is maybe more than it would have been at the 100 million. And so risk is very different. And so, at least with the founders that we're talking with, it's the first time I've heard this on a more consistent basis where they're at least offering and saying, what are the pros and cons of both of these models? And so that's good. I think it's a more educated example. And it's not just to get to $100 million. If my percentage of the pie is so small, is that really what I started out to do to start with?
And you're imposing so much capital markets risk to get there.
Yep.
And so a lower risk profile, lower growth, own more of a company at a lower valuation. The other thing I would say is, again, seed stage, earlier stage companies, a nice exit is a sale to a strategic. It doesn't have to be B, C, D, IPO. And so positioning a very valuable company in a niche, M&A will come back. The larger tech companies, SaaS companies, need to continue to grow, and they will be reaching for that growth through M&A activity. And so don't be always looking at capital markets as the solution.
Okay, that's good. Let's maybe pivot a little bit to the exits, right? Nobody gets paid. The entrepreneurs don't get paid. The investors don't get paid unless there's exits. I think I said this up front that, basically in 2023, there was over 1,500 companies that actually closed. I think a lot of those were some acqui-hires, so companies that basically just kind of merged with another company. And so there's not a lot of capital that's being redistributed back to the investors. As we talk about all of this and kind of the setting of it, how has that changed expectations for both investors and for startups, right? And so maybe I'll start with you, David. I think, from a Property Meld standpoint, you got this investment from Frontier. When you made that investment versus today versus what you think about in 3 or 4 years, has the strategy changed about taking either more money or thinking about looking at a strategic, or maybe how has that evolved, right? Because I think everybody's looked for a big paycheck, but yet the reality of some of this, as Blaine is talking about, is there's a lot of risk.
Yeah, I think I remember who said it earlier, but the more you raise, the higher the valuation, the harder it is to find a buyer, right? It's just the simple math of it. And so the other thing is not having a kind of a fundraising treadmill mindset. I think for a while, for us certainly included, there's going to be another round. We had a variety from, again, friends and family all the way through to a Series B. And, we had some bridge rounds, at least a bridge round in there. And so you kind of get hooked on, it's we're going to be able to raise again. It may be a big round, it may be a little round, we're going to be able to raise again. When you should be focused on, I think most people are focused on today is what are the core underlying metrics of the business and are those healthy? And so, kind of our view is if you take care of those, to Blaine's point, there will be a buyer for them because that's, you can buy growth in that fashion. But if you're burning money and you're looking for that next fundraising and that's your target, I think it's, going to be challenging.
Jim, any other feedback on that from an exit standpoint? I know, as the fund has gone from fund 1 to fund 2 to fund 3, you're starting to see different types of exits for your investments. And so are you guys getting more engaged in how to help manage that to good exits for the angel network? I mean, I'm just curious on how that maybe has evolved over, the couple of funds you've done and be a part of.
Yeah, that is the only way we get paid is if there is an exit. So, that is probably the driver. And it kind of gets back what, Blaine was saying as far as what is the potential of the company? Is it a niche market that's going to, get in that less than 10 million range and have an exit? What we found is that we were seeing pretty high valuations for where the companies were. So we were kind of the only game in town initially in the fund area as far as West River. So we ended up putting a lot more money in, and we've had 4 or 5 exits actually from our fund, and we've gotten some paybacks, but they're in that 2x, and for an angel fund and the risk level that we're going in at. That's why we've been pushing really valuations down, really kind of seeing that they have a good plan going forward. That, you know, we need in somewhere, you know, 5 to 10x type returns, because, you know, we've had some of the companies have closed down and failed. So on a percentage basis, at the early money, the risks are pretty high. So, you know, you got to look and see where that potential is going to be for that exit, and that should be part of the plan as well. Who is my potential buyer, and at what stage, you know, are they going to are you going to be able to exit? And again, it's one of those plays that, you know, the farther you get along, and the more customers you get, and the bigger, you know, your revenue and such are, you know, the bigger your potential exit might be from a buyout. So, you know, again, you don't want to kind of get in and sell early, because, you know, you're not going to get the kind of exits that we need or look for, you know, in those early round stages.
It's not an easy balance.
It isn't.
You know, I think, and it really depends too on the founders and kind of where they are and how much gas they got in the tank, because this takes a lot of energy to keep going. So maybe the last question I have maybe goes back to David and Bridget, just talking about, there's a bunch of entrepreneurs on this call. And so maybe talking a little bit about just your experiences. You know, I know, Bridget, you brought up one that I thought was really important right out of the gate. And I know that David and Ray would say the same thing. Fundraising takes way more time and effort than you think. And so start early. It is a full-time job on top of your day job as the CEO of a startup. So I think that's a key one. You brought up a comment to me last time we talked about a no is not bad if there's something actionable on it. And so I'd love a little bit more detail on that, because I think you have refined your pitch. You've basically you've listened to what people said, and you've realized that there's a type of investor that works for you, and then they carry more credibility to you as far as giving you feedback that you need to change in your business when you talk to them again or somebody else. And so maybe that as a starting point, because I think that was a really important one that you had last time we talked.
Yeah, absolutely. I think it's really funny because when you do get into fundraising, you're going to have a lot of conversations with people. You know, I've probably talked to, I probably pitched Filmeno even just virtually over 100 times, so to 100 different investors, and most of them are no's. And I think the first couple calls that I had it was kind of demoralizing. You know, you get off that call, they have so much feedback, constructive feedback, and it's really easy, it's very easy to take that personally, because ultimately this is your baby. This is something you invest, up to 80 hours a week probably doing. And you're very passionate about the solution. So obviously it's very easy to take it personally. And you can't. That's probably the first lesson that I learned is the no's are I need to get as much whys behind those no's. Why didn't you like necessarily what I pitched? Am I not portraying the information correctly or in a strong enough manner? I'm selling my business, and over and over and over again. And your sales pitch is going to get better as you improve if you're open to that feedback, to the point where you will start to get yeses, which is really exciting. And you know what? Sometimes the no's are based in reasonings that show, kind of as David was saying, there's some underlying metric flaws in the way you're running your company. And that's also very important feedback that you're getting. And it's important to either, find solutions to them or creatively solve those problems, or offer hey, this is what we're going to be using the capital to fix XYZ. But yeah, the practice and pitching is so important, just because you're, one, getting a lot of feedback, two, you're filtering out that feedback, trying to, improve your pitch as you go. And ultimately, yeah, the goal is to get the funding and to just keep that company moving forward. So yeah.
Okay, good. David, I think you had a similar experience. I think when you guys, before you had inked a deal with Frontier, and I think kind of builds on what Bridget was talking about, was there were some fundamental flaws maybe in the underlying mechanics or the metrics that we were talking about. And one that came up to me was just kind of customer acquisition cost. And so I think I think there was lots of people interested in the business. I think you got a bunch of feedback on maybe your customer acquisition cost and your payback period wasn't what the industry was expecting. And so then there was some changes in it, and then you went back out. And so maybe talk a little bit about that and how you internalize like to Bridget's point, no, but there's something constructive that we need to do to change in our business. And as entrepreneurs, that's hard to do.
Yeah, I think the kind of like cornerstone of good entrepreneurs, like you can take competing feedback and still have a strong vision about something. But I think, to Bridget's point of, speaking with 100 different investors, I think that's like a crucial thing because one, most people aren't probably from a finance background, and so you probably don't even fully understand the variety of, businesses that private equity and VCs have. And so taking a moment to understand those, and if you're getting the same type of feedback over and over, there's probably something there that you should be listening to. And so, for us, it was a customer acquisition cost. And, we're at a stage of our company where we can, move these things over time. And so we were able to kind of take some of those feedback, and we actually did materially improve a couple different metrics, which I think obviously helped us in the long run.
Yeah, it's good. Okay, well, good. Well, you guys have done a really good job of kind of staying on pace from a time perspective, so I really appreciate that. Mike's going to join us here to kind of go through. I think there's been some questions that the audience has provided, so why don't we take a little bit of time? Mike, do you have a first question that we can give our panelists?
I do. I think this one's for Blaine, and this is sort of the macroeconomic question. How long do you think this is going to last? Are we stuck in this, sort of depression of where valuations were at in the long run, or do you see an immediate bounce back based on what you're seeing in capital markets?
No immediate bounce back. Things take time. The economy is a big ship. And so as interest rates start coming down, it will help. I think there are more important drivers, and that is venture capital sitting on billions of dollars that needs to be invested. And limited partnership agreements have a clock ticking. And so they will need to eventually get that money out. I think we'll be at a step function reset of valuations, as we've talked about. But I think money will start flowing back, and it will be slowly later this year and pick up pace. But it's going to take a while. And I don't think, nor do I hope, it ever returns to 2021, 2022. That was an undisciplined market.
I think you said something really important, that discipline is going to stay with us. And so some of these metrics we're talking about and being capital efficient, you talked about earlier, that's a skill that you're going to need no matter what happens in the capital markets. And you're seeing that too. All right, next question. Thank you, Blaine. Next question is related to this. I think this one would be good for you, Jim. This is how important is beginning to generate revenue in this new environment? For a while, you could raise $10 million on an idea, and it just didn't matter if you were generating revenue or having a business. When you look at these deals, Jim, as a early stage high risk investor, how important is revenue as you look at the company?
Well, it's become more of a factor because, as I say, with the valuations where they've gotten to, and again, kind of back to what Blaine was saying, I mean, the valuation's got to come down for where we are at this early stage for us, because there's really no exit value, no incentive for us if we don't get some kind of multiplier on our investment. So that kind of straight off. Say again exactly the question.
How important is having revenue?
Yeah. It's become more of a factor, like I said, just because the valuations have gotten where they are. That if we're going in and they're asking for a very high valuation, we're saying, well, gee, you got to have some kind of a customer or something's really proven out there, or somebody at least on a letter of intent that shows that, hey, if you want the $5 to $10 million type valuations, that just is kind of out of our league unless there is some kind of revenue involved in it. So yeah, it's a factor. Like I said, it's really kind of what their ask is, where they are as a company, and what their potential really is. So if they're looking for a high valuation, they're at our stage, they're going to have something that shows that they can make a revenue or at revenue at some point.
Yeah.
Mike, I guess I'd kind of build on that a little bit further too. It's like, I think any stage you're looking at this, you got to execute well. If you've got customers, even beta customers, turning them into revenue and being as capital efficient as you can, it doesn't matter where in the continuum that we've talked about you are. the more the people are going to take calls if you're doing those things well at each one of those stages. And so I think everything that everybody's been saying is really a compression of how do I do that better at every step of the way, all the way through this evolution.
And as I kind of mentioned, I mean, to me, that's a key for somebody coming in with a look at how they're going to grow. What are the stages of development they're going to go through, and are there metrics that they can actually measure? It doesn't have to be revenue, but are there deliverables that they need to do to get to the next stage of investment and funding, and are they able to achieve those? So,
Okay. Bridget, you're in the middle of fundraising, so I think it'd be interesting for our attendees on that. How has the revenue conversation changed since you started this last summer?
Yeah, I was actually going to pipe in on this one. I would say it is very difficult to raise funds if you are pre-revenue. We are pre-revenue, and funds that we were targeting that were, very open to pre-revenue are no longer open to pre-revenue. Like, some of the no's have been because we are not, post-revenue. And so because of that, we've had to come back together and be like, what can we do to offer a premium feature? What can we do to do XYZ? To not inhibit our growth, because we're a free platform. We've seen much quicker growth than some of our competitors. But if that's going to prevent us from raising capital, we need to find that happy medium of finding creative ways to start making some cash. So I would say, it is really difficult to raise money if you don't have some money coming in, but also there are creative ways I think that you can come up with doing that, which in turn, if you can go back to that investor and show, hey, this is what we've came up with or what we come up with, it can be attractive to them to see that you're creative and willing to hustle and can find new ways to diversify your income. So yeah, I would, if it's possible, I would definitely move on finding ways to make revenue rather than to sit on it.
Great.
Mike, I'm sorry, I just want to jump in. Bridget makes a great point. Not everyone is focusing on high level points of discussion. Not everyone on this call, the market overall is. Not every dollar of revenue is the same value. And I think one of the things that Todd and David and Property Mill did very early on, even before a B, was to understand gross margin, software. You're all probably software or technology enabled business services, which imply a certain profit margin, which then generates cash flow to reinvest in the business, customer acquisition, product development, or whatever. If you're just raising revenue dollars, but the profit margin isn't there, that will lead to a no as well from an investor. So I think Bridget's making a great point. Find the revenue model that shows you're creating something of value and you have some pricing flexibility or control. Otherwise, just a dollar of revenue doesn't mean that much to an investor.
Yeah, that's a good point. Well, good guys, we're kind of reaching here towards the end of the hour of the webinar. I think we'll leave it here. I think this has been a great discussion. I certainly appreciate all of you from a panelist standpoint, making the time, being prepared, staying on kind of message and your time frame. I think it created a really good conversation between entrepreneurs that have kind of gone through this and then people that are actually basically making the investments. So I think that's been a good balance. As I mentioned in the introduction, I work with Wildfire Labs and Mike Vetter. If you guys have a business idea that you want to turn into a company, we'd love to hear from you. You can just head over to our website at wildfirelabs.io. And really appreciate you guys for joining today. And you guys have a good afternoon. Thanks again. Take care. Bye-bye.